Hi, my name is Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about my investment portfolio. A lot of you have asked me, Adam, what do you do? How do you invest your money? How do you build out your plan? How do you take care of your family financially? All of that. So I want to start kind of going through that process with you guys on what I do. Because at the end of the day, Parallel Wealth, like the company name Parallel Wealth, and you'll see in our logo here, there's kind of the two L's kind of slant up. And the whole concept of parallel, walking in parallel with our clients is really what I recommend to clients is exactly what I'm doing on my end. It's 100% why I do what I do is to figure out, what works for me well, for my family, and then implement it alongside for other clients as well. It might be retired clients. Obviously, I'm not in retirement yet, and I'm a few years away from retirement, but we've walked hundreds of Canadians into retirement, and we've seen things that work, that don't work, and we try and take all of that and pass it on to you guys that are looking to retire, or maybe you're early in retirement and stubbing your toe a few times over. So I'm going to cover three things in this video. The first thing we're going to talk about is my strategy and goals. So what are the goals I have with our money, with our family money, with my corporate money, all of that, and the strategy I implement when investing my money, when saving my money. The second piece is risk tolerance. So I'm going to go through my personal risk tolerance, why I've come up with this risk tolerance, and how it's going to evolve over time. And the third piece, probably the most important piece, is tax planning. So how do I kind of build out my tax plan? Because I have, my personal life, I have 4 young kids, my wife, kids got to go to school someday, all of that, and then I have my corporation. So how do I kind of merge everything together, both now while I save, but also later down the road when I retire? So I'm going to break that down as well at the end of the video. Before we jump into it, you might wonder why there's a blue sheet behind me here. So again, I want to highlight my kids, and I mentioned that in an earlier video. So this is one of these things where it said, "My daddy." And this is from Easton, so this is from my 5-year-old. He did this in preschool this year. So they go through, and my dad's name is Adam. He's 40 years old, which is close. He's as big as a building. His blonde hair, blue eyes. His favorite food is watermelon, which is probably true. His favorite color is green. He likes to go to the pool, and for fun, he likes to go swimming, which is funny because we hardly ever go to the pool, so I'm not sure where he gets this from. My favorite thing to do with my dad is play dinosaurs. And it's interesting. Some of these come back, and they're really funny, and some of them tell me that he loves to play dinosaurs with me. So these are the types of things that my kids bring home. I just absolutely love. So anyway, I want to highlight my kids obviously in this. My kids are a big part of my life, obviously. And you'll see this as I dive into my investment strategy here. You'll see there's a large piece carved out for my kids, both now and in the future. So let's start with my investing strategy. So every dollar that I save, I allocate out 80-20. So, you've heard of the 80-20 rule. And typically that's in a business where 20% of your clients generate 80% of the revenue. When you have a business, you typically focus on that. Now, on my investing approach, it's the 80-20 rule as well. 80% of my money goes to a portfolio manager that manages that money for me. They buy blue chip dividend paying stocks. So I personally use BCV Asset Management. They're an investment firm out of Winnipeg. They manage just over $4 billion in assets. So they're kind of a mid-sized firm, but all they do is buy blue chip dividend paying stocks. And they're going to own between 40 and 50 stocks for me in my portfolio. If I had bonds, and I'll get into this in a little bit, but if I had bonds, they also buy individual bonds. So they're not out there buying mutual funds or any type of funds or ETFs. They're buying the underlying stock. And I like that. And every company they buy has to pay a dividend and has to have a history of increased dividends and increased earnings. And they've done very well for me. So they've done, performance-wise, they've done very well for me. And we have a lot of our clients that we've referred there as well. Our clients obviously have done very well as well. It's very meat and potatoes. And my philosophy, if you follow this channel for any period of time, my philosophy is keep it simple. To me, an investment strategy where I'm buying big, large blue chip companies on a value approach that all pay dividends, to me, that is meat and potatoes. That's keeping it simple. That's what I like. So 80% of my portfolio goes to BCV to manage. I don't touch it. They take care of it. They manage it, so I don't have to worry about it. The other 20% of my portfolio is self-managed for now. And I say for now because that is transitioning out over the next probably 2 to 5 years. Now, the other 20% is broken down into a few categories. So there's speculative, there's a growth stock, there's tech, and there's others. So of that 20%, I put 25% into speculative. That is my 5% that I'm willing to lose. I buy risky stocks, maybe something I've, done some research on that I like that's coming up the pipeline. But if it goes to zero, I can afford to lose it. I have that itch. And I always say, if you have that itch to scratch, figure out what you're able to lose within your plan and maybe do that. Typically it's 2 to 5, maybe up to 10% if you're, making lots of money. I've set my limit at 5%. Another 25% of that 20%, so again, 5% of my overall savings goes to crypto. I don't know where crypto is going to go. I'm no expert in crypto, how it works, but it's an alternative asset, and I like to add the odd alternative asset to my portfolio. So I've added Bitcoin and Ethereum into my portfolio. Now, I've bought them directly, and I've also bought some ETFs. There's some ETFs through Purpose that I've used. They pay a bit of a yield, and so I've used them that way. Again, 5% of my portfolio. Now, if I lose that, that's okay too. So technically, my speculative might be up to 10. I don't think crypto is going to zero. I think you're going to have big swings like we're seeing right now, but it's just an alternative piece to my portfolio and to my overall savings. The other 50% of that bucket, so 10% of my savings, goes to growth, tech, stuff that BCB doesn't hold for me. Things like Tesla stock. I own a Tesla. I love Tesla. I think they have a long runway ahead. Obviously, they're quite volatile as well at times. Companies like PayPal, when PayPal dropped in price, I bought some of that. Again, this is not investment advice for you guys. Let's just put up a disclosure here. This is not my investment advice, say go buy this, that, or the other thing. I'm not licensed to do that, and I'm not recommending that. I'm sharing what I do on my end, and it's more about the percentage of savings, how I do it, and that. Don't concentrate on necessarily the stocks that I talk about. It is not a recommendation. If you're investing, especially DIY investors, do your own research. They always say to research a stock, you should be spending 8 to 15 hours per stock before you buy it. Do your own research or hire a professional to do it. Again, I hire a professional to manage the money that matters to me. This is not investment advice. This is just my personal investment approach to how I save my money. So again, why I kind of carve out that 20% to DIY right now. Of the 20, 10% of that is, either speculative or crypto. The other 10% is more growthy plays that I like right now. I don't know why, but I just get attracted to it, and it's definitely not doing well for me this year, but that's okay. Eventually that 10 over the next few years, I'm going to transition that 10% over to BCB. So the end goal within a few years, 90% will be a BCB professionally managed. The other 10% will be speculative, kind of my play money essentially. So that is 10% that, yes, I prefer not to lose it. I hope I do well with it. But if it does go to zero, that's okay. It's not going to delay my retirement or change, my kids going to post-secondary or anything like that. Now, the 80% I'm saving with BCB, that's my safe money. That's my kind of longer term money. So I'm saving that for three things. I'm saving it for retirement. I'm saving it for a home upgrade, and I'm saving it for my kids. So helping them with education, maybe getting into real estate, whatever it is. So it's kind of a long-term play. So BCB knows my goals. They know how to invest the different accounts I have there. I have RSPs. I have a locked-in RSP with my wife there. We have our TFSAs. I have a corporate account. So depending on what account, they know what it's for and they invest it accordingly. Now let's look at the second thing, which is risk tolerance. And my risk tolerance is very high, much higher than probably 99% of you watching this. Now again, I'm about 20 years from retirement. A lot of you are 5, 2, or in retirement already. Your risk tolerance is very different. And that's why I talk about my investment approach, what I invest in is probably very different than yours, but the philosophy can be there. What you really need to take from this video is if I save $100, where does that $100 get spread out to? Am I able to risk any? Do I need all of it safe for long term? What is long term? Is it retirement? Is it a home upgrade? Is it helping kids? Is it what's it for? You need to allocate that. And that's how I think about every dollar that I save. Where is that going? What is it intended for? And I need to make sure it's going to the right bucket so that I don't put my kids' education money in crypto. To me, that's not a good fit. It might be for you, but it's not for me. So I want to make sure that 80% that I'm putting over to BCB and they're managing, and again, 90% will be very soon, that money is long-term. So again, time is on my side. So I have a very high risk tolerance. In fact, I'm 100% equity. I currently don't own any fixed income. Now that will change as I go forward, and especially with interest rates going higher. As I can get my 5, 6, 7% clip on a bond, a yield on a bond, I will start to transition some of my money into that space as well. But for now, I am 100% equity just because my risk tolerance is higher. I'm a bit younger. If my retirement is in 20 years, that means I need to start pulling money out in 20 years, but I don't need it all. So really my time horizon for a lot of that money is kind of 20 to 40 years. So very long time horizon. My kids are probably about 15 to 25 years. That's when my daughter will hit university. So I'm gonna, we're doing the RESP. The RESP is a great tool. If you have kids, start saving to an RESP because the government gives you 20% right away, up to $500 every year. So you can contribute $2,500 per kid. You get $500 from the government. That's a no-brainer. So we do the RESP, but we save above and beyond for post-secondary. Maybe they don't use it for that. So we use a down payment for a house, whatever it is. So again, probably about 15 to 25 year period for that. So longer term. And part of my money with BCV is a bit shorter term, probably 3 to 8 years, and that's for a home upgrade. So eventually we need to get out of the house that we're in right now. We want to get something with a bit of a basement, more space for the kids, and my business is on the property here. So my studio staff, we're on my property here, so we have a separate office, and we're growing. So I need more space eventually. I also think this. So a lot of you are in a space where you've maxed out your TFSA. If you're kind of in your 40s and 50s and still building up for retirement, think about this for a second. This is how I think about it. It's a little different than most things, but if you've maxed out your TFSAs, maybe you've maxed out your RSP or you're utilizing it efficiently, but you maxed out your TFSA and you still have more money that you want to grow tax-free going forward, there's only one other place you can do that, and that's in your principal residence. Now, a lot of you will push back and leave a comment and say, yeah, I'm Adam, but the government's going to tax us on that eventually. I don't think they will. I really don't think they will. Most tax experts don't think they will either. Now, if you're flipping homes all the time, yes, maybe. But as your long-term principal residence, they're not going to go after that, I don't think. So it is the one place that your money can grow tax-free. So if you hit a point where you've maxed out your TFSAs and you're still building up assets that you don't need, maybe until 10, 15, 20 years down the road, a home upgrade of your personal residence can actually be a great strategy. And that's one of the reasons we're looking to do it, is we can upgrade our house, we can grow that bigger asset tax-free going forward. When we sell it or downsize, we can cash out that money tax-free. Think of your principal residence much like a large TFSA account. So that's one of the reasons, one of a few reasons, we're looking to change homes at some point in the next 3 to 8 years. The other reason I have a very high risk tolerance is because I have earning ability. Right now I'm in my prime earning years, right? Like 40 to 60 is kind of those prime years of earnings. And so my ability to save right now is quite high. I'm able to take more risk with my investments because I'm able to pump more money into my investments than I have previously. So if I'm able to save $100 a month, then I'm putting $80 to BCV, I'm putting 20 over here, but I'm able to be more aggressive because I'm able to save that $100 guaranteed every single month. So whatever that is that you're saving, you'll figure out your strategy. But if you're in a period of high earnings, high savings, you might be able to, and again, run this with your planner, but you might be able to be a bit more aggressive with the money because the cash flow I'm putting into my savings outweighs the earnings that I'm having. Now that will flip eventually, but because I'm saving so much in right now, it's more than the growth on my portfolio or expected growth on my portfolio. It allows me to be a bit more aggressive. The last thing I want to say about risk is my view on my portfolio at BCV. So 80% of my portfolio are big blue chip companies that pay me dividends. And so even though I'm 100% equity at BCV, I don't see it as like a high risk. Like I'm not 100% tech stocks or some risky play. I have 100% in equity, but I'm getting 4 to 5% dividend yield every single year. I own big companies, Canadian banks, energy companies, railroads, Johnson & Johnson, Microsoft, FedEx, large companies that I don't think are going anywhere. Their stock price might fluctuate a bit, but I'm getting that dividend along the way, and I think long-term growth is really good for these companies. Yes, I'm 100% equity, but I do see it as not a high-risk equity play. So that is one thing to be aware of. The last thing I want to talk about my investment philosophy, and again, a lot of you will fit into this. If you have a company, like how do you kind of use your company and personal and save money in your company? Do you shove it over to you personally? All that matters. So what I do is I take out enough money out of my company and pay myself a salary to top up my TFSAs and max out my RSP every year. Those are my two goals every single year. Max out both my wife and I TFSA and my RSP. Everything I save beyond that is saved within my holding company. So I have an operating company and a holding company. I move any extra money from my opco into my holdco and I invest it. And that money is at BCV as well. So a lot of you wonder, I've met people, talked to people that are sitting on hundreds of thousands of dollars, millions of dollars in their operating company or holding company, and they don't know what to do with it. They don't know how to invest it. They don't know that they can invest it. And you absolutely can. Treat it like another entity to your overall savings plan. So my holding company, where I have my cash, that's set up at BCV. So I have a holdco investment at BCV, and it looks very much like my TFSA and RSP. When I want to pull money out, it's going to be taxed down the road, whether it's dividend, salary, however I end up pulling it out, depends on my structure then, but that doesn't matter. In the meantime, I can take it, it's corporate money, so I'm only paying corporate tax on that, so a much lower tax rate. So I have more money to work with. Let's say I had $100,000 in my company and I wanted to pull it out and invest it. If I pulled it out, I'm gonna pay around 50% tax. So I'm only gonna be left with $50,000 to invest, which is great. I can invest $50,000 and grow that over time. It's after tax money, but I'm investing it in a non-registered investment account, which means that I'm gonna pay tax on any gain every year, interest, capital gains dividends every single year. But if I leave that money in my holding company, I can pay 11% tax. I now have $89,000 to invest. So I have a much larger number to invest and work with. Now, again, you have to be aware of how corporate investment works. The first dollar that you earn on a corporate investment is taxed at the highest marginal tax rate, depending what province you're in. So understand how corporate investments work. Talk to your financial planner, your investment planner, whoever you're dealing with. Typically, you don't want your corporate investments in mutual funds and things like that you have little control over, that spit out interest income. Not a good idea. For me, I have my holdco money 100% in dividend paying stocks. It works very well for me and it grows very well. Now, eventually down the road, depending on how things go, how much I can say personally, let's say 5 years down the road, we're looking to upgrade our home and we find a home and we need some money out of our savings to buy that home. If I don't have enough personally in my TFSA, I will then utilize my holding company. That I'm going to pull out. I'm going to pay tax on it, but I've allowed it to kind of grow in a more efficient way until that point. So if you're sitting on the other end watching this and you have a company, you have a holdco, you're able to save within that, you have a serious conversation with your financial planner to see if that makes sense for you. Probably does. Get that money working for you in an efficient manner. If you have any questions about that, reach out to me. Again, our office here at Parallel Wealth, we focus on planning. So when I look at my overall structure, I look at, okay, the 80%, where is that going? How am I saving it? What am I saving it for? The 20%, okay, how is that structured? So I have three main things I'm saving for. I have a pretty good timeline on all three things. So I can kind of build out my savings, my risk tolerance, and my portfolio to match what I'm looking to do. And that's what financial planning is all about. Know where you want to go, know what you need to do, and then match the plan to kind of roll that out to make sure that you get to those financial targets. So if you're watching this video and you're in the accumulation phase, you're saving up, I want you to think about it this way. For every $100 that you save, how are you allocating that? And if you don't know, this is the time to sit down and start that out. Map it on a piece of paper, put $100 at the top. What are your goals, right? Your goals along the bottom, and then start allocating money. And then from there, you want to make sure that what you're allocating to certain buckets is going to get you to your financial goal. And that's often when you reach out to a financial planner to figure out, like, is this mapping working properly? Am I going to have enough at retirement? Am I going to have too much, not enough? What's my tax situation? All of that, a certified financial planner can map out for you. But I encourage you to start on your end, to just put the number at the top, whatever you're saving, say $100 a month, $100 a week, whatever it is, put that number there and then map it out, what your goals are, where you want to allocate your money to for kind of the mid to long-term savings. If you're already in retirement or you're very close to retirement, I want you to look at one thing, and that is, how have you allocated your money? I was talking to someone yesterday and they said, we don't have any TFSAs. We have a bunch of money in our company, we have RSPs, but we have no TFSAs. And what that does is it creates less flexibility for income in retirement because everything's taxable. If you're ramping up to retirement or even early in retirement, I want you to look at the accounts that you have, the investments that you have, and are they structured in a way where if you need an extra 10 or 15 or $30,000 out of your account, do you have the ability to pull that out tax-free? Do you have that structure in place? And if not, I want you to start working towards it. Maybe it's drawing your RSPs out a little bit quicker to build up a TFSA. Maybe it's taking more to your holding account to build up that TFSA. You need to do this in a tax-efficient manner, so it's very intricate, but I want you to work over the next, say, 1 to 3 years to start building up your TFSA account if you haven't already. We build plans every single day here at Parallel Wealth, and the more flexibility you can have around both TFSA and non-registered accounts, the better off you're going to be, the lower amount of tax you're going to pay. Hopefully that helps you. Hopefully gives you a bit of a picture where I save, how I do that. Again, I don't divulge numbers. I don't think it matters, if I have $10,000, $100,000, or $100 in my accounts. That doesn't matter. The strategy is what matters. Now, if you're ultra wealthy, your strategy probably changes a little bit. 99% of us watching this, your strategy needs to be based on not how much money you have, but the outlay. So whether that top box is 100, 1,000, 100,000 doesn't really matter. How are you allocating that down? Thanks so much for joining us in this video. If you're still watching, please hit the thumbs up, hit the subscribe button if you're not already a part of our community, and we just thank you for the views, and we'll see you in the next video.